Good afternoon, everyone. I'm Mrs. Jenny Prajit, the Vice President of Institutional Council, Innovation Council, Pillai College of Arts, Commerce and Science. Welcome you to the talk session, which is conducted by Mr. Ram Gopal. We are holding this talk session for our students who are budding entrepreneurs. Just to know what are the sources or what are the different types of capital sources that are available in terms of venture capital. So we'd like to start the session. I'll ask the president of IIC, Mrs. Nithya Varghese, to please introduce the speaker for the session today. Thank you. Over to you, Nithya.
Thank you, Jenny, madam. I welcome all of you students to be a part of this talk show today. To introduce Ram sir, actually it's quite a big task and I'm privileged to do so. Ram sir contributes to the in-country leadership with focus of strategy and execution. For the onshore business, he is responsible for designing and execution of a country strategy that support the financial performance and market position of the bank entry in India. For the offshore and the private bank business, he provides effective support to country manager in the discharge of governance responsibility. He has been in this role since 2017 and he is a member of Country Management Committee and until recently on the board of Barclays, Shared Services and Barclays Technology Center. Prior to this role, Sir was the Chief Operating Officer for Retail and Corporate Banking Division, GRCB, since July 2007 and in 2009 he was of GRCB division in India. Thank you, sir, for the talk. I hope that with your knowledge and expertise, lot of dilemmas which are there in our students' mind will get solved. Welcome, sir, for the.
Over to you, sir. Having me here. Thank you. Can you hear me? Just one dive in.
Yes, sir. Yes.
Fantastic. Hello, everyone. Thank you, Nithya ma'am. Thank you, Jenny ma'am, for having me here. Hello, everyone. Pleasure to be with you. And it's fantastic to see how much entrepreneurship and the idea of creating something new is spreading far and wide into such enthusiasm. I also learned quite a bit in this process. Before we, jump into what we're going to cover, I think, if you were to step back and think about generally how companies approach growth, it is very clear that, there are many avenues open. One is, of course, they could continue to be doing their existing product set, existing market, and they could think about how they could continue to do that more effectively, more efficiently. The other spectrum could be where they could think about entering new markets. So I'm possibly focused in India, maybe can I look at some other markets somewhere else? Or it could be that I could continue to think about geography as India. But there are many different avenues to grow if you think about a simple product and market 2x2 matrix. Yeah. What we are going to be talking about is you can either take the viewpoint of an existing company, thinking about, okay, how do I bring in either a new product or a service, or venture into a new market. It could be an existing company, or are, which is, I think I have an idea, I think I possibly see some structure in my mind. Can I bring that to life? Yeah, so these are possibly, I think what we're going to cover can broadly fit these two, but I will try and make it more relevant to the second set, which is, we aren't talking from the point of view of an existing company, but we are talking about something in terms of a setting up a new company. So there are two things that I want to touch on today. The first part of my conversation, I just want to talk about how does one bring, or how does one think about a new venture? What are some of the, what should I say, hygiene factors? And then the second part of the conversation, I hope, as the title suggests, the dangers of, venturing into the venture capital space, taking money from institutional lenders. I think we will try and touch on that aspect. If any of you are in this call thinking that, hey, Ram is going to give a list of phone numbers, contact details of people who are willing to open their purse so that, I can start my venture, I'm sorry, this isn't that kind of a session. I'm just going to lay you pretty basics so that you're better informed as you think about whether at all you want to raise funds for your venture. First of all, whether there is a venture, whether it will succeed. And if you think it will succeed, and if money, capital is almost everywhere a constraint, how should you think about it? So I will give you tools for thinking as opposed to a spreadsheet of names of companies and contact details of who you can get in touch with. Yeah, so that's kind of foremost. I think we should talk about how we can create a new venture. And almost always this new venture starts with trying out a customer problem or a customer need. Why is that very important? And often is the case, I think we've seen that during the early 2000s, when we had this era, where we had several jazzy technologies that came into being without a business model that supports it, right? So rather than just be enamored by an idea, a product, or a service, it is often important to understand whether that product, service, or an idea solves a real need for a real customer out there. Yeah, thing is to think about what is your value proposition for the customer. And the way I articulate this value proposition is thinking about an existing customer has that your product, service, or idea solve, or is something that your product and service or idea does that makes it better as in it could be cheaper, it could be faster, it could be more convenient. Those are fuzzy things. But if there is clarity on how you are creating value to the customer, then I guess that's a big first step. So there is something called a customer value audit that one can go through in order to understand understand how robust your idea proposition is. And how does one do that? Typically, you start with by doing or engaging with customers. It could be that you have done a lot of secondary research as in you read newspaper articles, you read other research reports, in your close circle, you speak to various people, and you get an idea that, okay, here is something that I can bring to play that is different from what already exists. So if that is the case, then I guess it is important then for you to now validate that by asking to a set of people to whom your product idea is oriented towards. Yeah, so first is what need or what value are you creating for the market? That's the first question. The second question is, how do you validate that? And that, I said, is largely through market research. It could be secondary research, but followed by secondary research, you have to engage into your market to try and understand whether this product idea actually has currency or relevance. And what suddenly, when you think about market, India has whatever 1.2, 1.3 billion people. So what is your market? Is it defined as some parameters? Is it over young people? Is it focused on, let's say, people, let's say, for example, if it's an investment product around retirement, who are you focused on? Or are you focused on young, up-and-coming, aspirational millennials? So when you think about market and you're thinking about engaging with the market, you then understand that you need to segment the market in order to make this meaningful for yourself and for your value proposition, validation through research. And before you get there, you have to be very clear about what your target customer market is. Yeah. It could be business to business as a service. Your idea, your product could be something that is not oriented to an end consumer. It could be oriented to institutions. It could be large institutions. It could be small and medium enterprises. It could be micro enterprises. It could be for fellow startups. So if you now see the spectrum of potential, you then see that it is very, very important quite quickly to narrow it down to your target segment. Yeah. Now, okay, fine. Let's assume that my idea is to do a software as a service product, and the target segment is, let's say, business to business. And let's say again, in business to business, it could be typical industry. It could be, are you doing some airline software? Are you doing a hotel management kind of software? Are you doing something specific to the banking industry? There are lots of banking industry oriented software as a service proposition that you have in mind. Now you get into something called an audit of why you feel you are best positioned to take advantage of that idea or proposition. Yeah. So I want to introduce this concept called moat. I don't know, some of you may be management students, some of you may be science students, but typically you need to do an analysis of why is it that you feel you are better equipped to be able to market and capture value out of your idea. So in the first step, what we have established is there is value creation potential for your target customer in a target market with your specific proposition. So you've kind of done that. Now you're asking the question, because I can create value for the end consumer, is it possible for me to capture some of the value for myself and for my venture? If you can't, for various reasons, and we can get into some of those reasons just now, I think it is better for you to try and see whether there is any other way by which you can use the idea, product, service that you have in mind. You could either combine forces with else. That's why you that are being announced almost every day in the marketplace. Or you could just think of licensing. You could patent your idea, product, or service, hand it over to somebody who's got a lot more resources, maybe a lot more distribution capability, and you could potentially use them in order to, you take value by virtue of licensing. But after that, that company, whoever you sell your license to, engages with the end consumer. So there are many different ways to think about how you can capture value. And it's very important. And how do you do that assessment of whether I have the potential to be able to capture the value myself? You do something called an audit. Yeah. So, and the audit is typical, what you do, even we go through and we do this for our own personal. So let's say, for example, you are in a company, or let's say you're okay, what lies ahead? Where should I join? Should I continue studying? Should I join somewhere? Should I set up a company? You have various things going on. How will you make your decision? You will do what is called a SWOT analysis. You will find out what your capabilities are, what your strengths are. You will find out what you're not very good at. You will find out, therefore, given a combination of strengths and weakness, how are you then thinking about this idea? And I'll give you an example of that. So let's say, for example, you are strong on the technical side, but you are not, possibly exposed to marketing it or creating a brand or packaging it, selling it, talking to various supermarket chains, etc., to showcase your products, etc. Those kind of skills maybe you don't have currently. And that you could think about, like I said, seems to be a big deal. Okay, can I partner with somebody? And in that extreme, it could be that, okay, my idea is here, let me sell my idea to somebody else, and that's it. So you understand where I'm going with it? So the first you start with the customer value proposition. You then, through research, establish there is potential value creation for your idea or service. Then you do an audit about your own capabilities to see whether you extract value. And that is in two steps. The first step is you try and see whether it is possible to generate money out of that. We call it generating a profit equation for the idea, product, or service that you've got in mind. If you don't have, and you think about this, there are many people who think platform like, they're getting inspired by Amazon, Google, all of these big tech companies, and they believe all they need to do is to get few clients here, get to sellers on the other side, and you kind of create a platform in between, and you think you can just take a slice from the buyer, take a slice from the seller, and lo and behold, I have a profit engine. It isn't as easy as that, right? There should be, so in order to deploy your technology, what does it take? So you have to create what is called a business case. Yeah. So you need to incur in order to bring your product into shape. What kind of people do you need to be able to bring that promise into reality? So you think of all that you need, your key processes, your key resources, your key capabilities that you need in order to bring your idea, product or service to the market. And you put them down. The ways by which I can monetize as and create money in this, because ultimately, unless you are for your idea venture is not a non profit organization. The assumption is that you're doing it because you want to generate some wealth for yourself, some profits for yourself. So if that is the idea, then you have to figure out what are all the ways by which you can generate revenues from that. A business case, you have what your customer is, what is their need or problem they have, how is it that you think your solution is going to solve that problem. So that's the value creation potential. Then you say, here is all the resources, processes, capabilities that I need to have in order to bring this service into play. This is what it will cost. And in order to, by deploying this idea, product, service, I'm able to get money from these avenues. If you have this in mind, you are in great shape. Yeah. So you have solved for a need. You have an idea of how to solve that need. You have done a validation that your product and service can indeed solve that need in a better way, in an effective way, in an efficient way. You understood what it takes to bring that to life. You are in a great place. Yeah, I'll take a pause here. We've been going for about now 15 minutes. And maybe if there are one or two questions, just to check people have understood what I've said thus into the second part, which is the financing part. Yeah. So any questions thus far? Nitya ma'am or anybody else who has the questions, anything?
Yeah. Shahar?
Relevant now?
We have one question. One of the questions is, could you please tell us how you see the scope of venture capital in India?
Yeah, so I've not come to the capital financing part yet. I'm still in the idea part of it. Are there any questions on that? Because without a venture, what is the financing around a venture? And let me tell you, there is one important way to move from one to the another, which is the first section around, second section about how to get capital for your idea. There is an intermediate piece, which I'll come to in a bit. But just on the first piece, is there any more clarity? Yeah. So, maybe there is no question, which is fine as well. You think about the customer proposition, you think about validation, you think about what is the profit formula, you think about what processes, capabilities, resources you need to bring that into play. Yeah, so that's where we are. Now, historically, people have made an assessment around various things that is required in order to be successful in a venture. Yeah. So people are very interested to know about venture capital. So is capital important for a business? Or is it the product or the idea itself that is important? In some case, it is not just the product or the technology. For example, there are the shared mobility platforms, so Uber, Ola, etc. The basic idea was to use maps. So as a technology, you had that. You had that for several years. but they use the technology with a nice wrapper in a particular context. That business model wrapper is very valuable. Yeah. So going back to what I said is important. Is it the business model that is important? Is it people, team that is important? Is it execution that is important? What do you think? All of them are important. But is there a rank order in which there is a strong correlation between getting that right and getting that getting your venture successful? Yeah. So this does not allow for quick question and response. So please do write to me in the chat so that I know you're also engaged. There's a gentleman called Bill Gross. He set up the, he's been an entrepreneur. Nitya ma'am, I think you're, you've gone on. So there is a gentleman called Bill Gross. He set up what is called the Idea Lab. He has been in the venture space and venture finance space. He, by virtue of incubating several companies, he has had a chance to understand this question, firsthand. And he feels, and through actual real life incidents, he's come to realize that beyond all of this, factors that I spoke about, capital, team, execution, business model, technology, one of the most important things is to get the timing right. So of our own company. So in 2007, we wanted to launch a mobile wallet. Those days, 2007, if some of you may not even recollect what was the position because you would have all been very, very young. But those days, I think we do not have any wallets as these payment wallets, Paytm, PhonePe, Geo wallets, and all at that point in time. We were possibly one of the very few with an idea that we wanted to go and talk to the RBI about it. At that point in time, the RBI, of course, welcomed the idea. But because this was new, they put a cap on how much one could transact through these wallets. And they had kept that limit to as low as 5,000 rupees. Now, to take great pains, because at that time, smartphones weren't something called USSD technology, to be able to use feature phones, to be able to send money from one person to another person, to check balances, etc. So mobile banking using USSD was our brainwave to be introduced in the Indian market in 2007. And that was because it was so clunky, the technology, and with feature phone to be able to do this, and that to maximum, it didn't work at all. But then suddenly you see what happened after the demonetization, etc. Paytm was big even before that, maybe a couple years before demonetization. It just took off. Yeah. So the concept of getting the timing right is something that I wanted to mention it to you folks in association with the idea itself, as how important. That is why this validation of the need with the client in the market to see whether there are technical stuff on the first talk itself. We can at some point in time talk about it. Demand estimations. That's very important to see whether there will be a sufficient take-up. Established, let's talk about financing. Of course, capital is an important component of trying to bring your venture to reality. But as an entrepreneur, the first place that you, or the first place that you need to always have to start with is bootstrap, or whether you would like to take institutional money. Yeah, bootstrap is the concept, or is a terminology used if you are getting money from people which are your friends, family, people who know you, who are not really motivated to get something in exchange from you, like shareholding in your company, etc. They're not thinking really, they want you to succeed. Yeah, so that's generally what is meant by bootstrapping. Of course, there could be some variations to the theme. You could agree some bit of return, you could agree some bit of sweat equity, etc. I'm not getting into too much of complexity there, but essentially one option that you always have is don't go after institutional money, but use your own limited circle of influence to help move your company forward. About when you're ready to get to institutional money. Think about it simply. You have one revenue, you have another dimension, which is growth or product. You can think about it as, if you're seeing good early traction in the market, there is growth, really monetize, and you feel that competitively you're not very differentiated, then I guess I don't think anybody that you speak to saying, please put your money in this venture, is going to be too encouraged by what they see. Yeah. So you understand where I'm going with it. There has to be some bit of rationale as to why somebody ought to put there, because, like I said, the product has seen some bit of traction. You're already starting to make money, which is a fantastic place to be there. And month on month, you're growing, year on year, you're growing. These are the three typical dimensions in which people evaluate that. And if you got all the three as yes, fabulous, we are ready to talk. But there is another important caveat, which is every time that you go into an institutional investor and ask for money to be put in, remember, they are not in the business of building businesses. They are in the business of investing and exiting out of businesses. What does that mean? They are driven by a motivation of trying to get a return out of the money that they deploy in your company. And if your company is in the idea stage, or a little beyond that, you're starting to see some revenues coming, you're starting to see some customers coming on board, if that is the phase that you're going and taking the institutional investor, it'll be a long time before you will actually be able to make profits to be able to give back to the investor, right? But the motivation for the institutional investor to be engaged with you is because they will be able to get a return. You understand the paradox? The paradox is the company is still young to be able to generate healthy profits. You go to somebody who is motivated by generating a return for themselves. How do you do that? The only way you can do that is if you can again use the same vehicle and go and ask for money over and above what the first investor has given to another investor. And if the investor sees what is going on and he or she feels comfortable, then suddenly, if the first investor has put in, let's say, $1 million, and the second investor is willing to put some money in, he values the effort that the first investor and you as a founder has done, And that is the way by which the $1 million of the first investor grows in value, and the first investor sees some return. Are you able to understand this? I'll go over this a little slowly one more time. You have an option as an entrepreneur once you have validated that there is value creation and value extraction potential for your idea. You are in a state trying to go and institutional funds for your idea. And one option you always have is not to go institutional, is to use your own limited social circle to be able to get money and keep your company moving on. The minute it's being played up in the press, every day you see, Byju's has raised their third round, somebody else has raised their fourth round, Series A, Series B, it's almost becoming very, you want to be an entrepreneur because you want to be raising capital. It's as if that's a validation for how smart you are. Frankly, it is far from it. Yeah. The minute you go institutional investor, they are looking for return. And the only way for them is if you continue to be in this treadmill of generating more and more money for higher and higher value. And once that treadmill stops, suddenly you find that this unravels quite quickly. There is another concept called dilution, which I will come to in a bit, but I just will pause here. I'm not too sure whether people understood what I said about institutional money. So to your earlier question, Sahir, that you asked about what is this venture capital, early stage institutional capital. Yeah, these are specialist firms who deal with early stage investing. This is not typically the way you can raise money is two forms, right? You can either raise it as equity or you could raise it as debt. What does that really mean? In one, which is in debt, you have to return it back. You have to return it in such a way that there is interest every month alongside maybe some return of the principal, or you just keep paying interest up until the time the maturity of the loan comes, in which you have to repay the entire thing. When you go for equity, there isn't the notion that you have to return the money, but implicitly people expect a return on it. But there is no, the legal framework, etc., is such that you don't need to necessarily return it because of the business. Hello, can you hear me? Hi, this is Ram.
Yes, sir.
Sir, we can hear you. We can hear you.
Okay, I got logged out, so I kind of use my mobile phone. I'll try and sort out the other one. Let me just continue. Yeah, so venture capital is the term for institutional investors who look into early stage companies or who are interested in investing money in early stage companies. And typically they invest as in through equity They take ownership of the company. They help the founder or the entrepreneur build their business. And their hope is that over time, as value generation capabilities get established, they're able to make an exit by making a profit. What this means is that though there isn't like debt, an expectation that you have to return money, interest month on month, or at the end of it, they will only put in more money, or they will continue to stay engaged with you if and only if there is traction in the idea. So if you think about this, now you know why institutional investors or venture capital funds place such a high premium on the idea itself. Hence, it is important to do all the work that I said about what is the value proposition, what is the need, what resources, capabilities, processes you need to have, what is your profit engine. Only when this is established and you're able to gain some currency, I think, in my mind, it makes sense to talk to institutional investors. Yeah, there is something called seed funding, angel investing, etc. I'll come to that in a bit. So let me pause here and just check if there are any questions at this stage.
There's one question, that is, when is it a good time or the right time to approach an institutional investor?
Yeah, I would ideally think that you have 3 ticks. First tick, you are able to have your product gain currency in the marketplace, as in you are getting customer coming in. If it's a website, coming into your website, if it is buying something, you are able to see that happen. So traction in the market, I think, is a key piece. Second, of course, is growth, and the third one is you are able to make money, not in terms of profits, but at least the revenue line you are able to see. So these are the 3 conditions that I would think every founder, entrepreneur needs to think about before engaging with somebody. Now, there is many variations to the theme. I need some money just to create this product. I have an idea. I have validated it through my limited means. I have now a prototype. I now need to get somebody to help me launch it. Now, there are some angel investors, etc., who are there. Whether it is part of big PE firms, they have their own what they call it as incubators, accelerators, mechanisms by which they can even come earlier than the 3 criteria that I laid out. But generally speaking, for all of us in this room, I would like us to anchor to these 3 conditions. You're able to get good traction with customers. You are seeing growth month on month. You are able to generate revenues out of it. I think if all the 3 are there, very good chance that you can attract institutional money. Any other question?
Another question we have is, how would you analyze and assess an idea? What are the measures how do you measure the success of
the ultimate proof of an idea being successful is for it to gain relevance in the marketplace, right? So if, let's say, for example, you are launching, let's say, a new variant of an organic product, let's say organic ghee, for instance. Now, the idea, the fact that there is a large health conscious population, and the fact that ghee is coming back into vogue as a healthy diet is something that is well established. But what is it about you and your capabilities and your formulation of the ghee that is different from somebody else's, or from some copycat who can come in after you have established and educated the market. How are you differentiating yourself? That's going to be very important, right? So, and how does that show up? That shows up by repeat purchases. That shows up by churn that you have in your portfolio. How many people continue who have bought, let's say last month, is still continuing to buy this month? How many of people who signed up last month are still in your ecosystem in the next month? Yeah, so there are many ways by which, so there is something called growth accounting. You can go to some systematic exercise to establish whether there is something called a product market fit. So the only way to establish, going back to your question, the way to establish whether your idea is good is the proof is in eating the pudding, which is in this case to see whether you're getting growth, you're getting customer traction, whether you're making revenues, making money.
There is another question which I picked from YouTube now, that how much equity should be given in first time investment?
Yeah, that's a good question. I think this is the concept of dilution. Let me talk a little bit around that. I think when we approach an institutional, investor and ask them to provide, let's say, seed funding or pre-series funding, then I think at that point in time, the investor will be looking for a share of your company, and how much depends upon what is the valuation of your venture at that point in time. Now, how does one value a company when it is still in its early stage? So one could decide that, okay, we may possibly, there are depending upon, there are some heuristics depending upon whether you are a tech company, whether you are seeing revenues, whether there is growth. The value for your company could depend upon your annual sales. It could be starting from as low as, just I'm picking up a number, 1 time your revenue, to maybe as high as 8 times your revenue, depending upon how much growth, how much revenue, and whether you're a technology company or not, because technology produces leverage, and therefore the valuations of it is much higher. You think about this, banks, brick and mortar companies versus tech companies. If you look at the valuation, Google, Amazon, Apple, they're all $1 trillion in market capitalization. Whereas banks like us, which have been around for 350 years, we are still in the 30, 40 billion and trillion. You see the difference? So if you are a technology company, there is a higher valuation because there is lots of leverage. And we'll not get too technical around it, but fair to say that there is a range of the value assigned to your company could range from 1x of your annual revenue to several times your annual revenue. And when somebody comes in at that point in time for your the question was at the seeding stage or for early stage, when somebody is coming with money for that, depending upon how much money you need and how much your company is being valued, you can easily figure out what is the share of the company you'll need to give. And the concept of dilution is that if you, let's say you're just for numbers, and I'm using very simple numbers so that I'm not using a whiteboard here to market. So let's say your company is valued at 1 crore. Let's say that there are 2 people in your company, you and your co-founder. Let's assume that for simplicity's sake, each of you had 50-50 share. Yeah. So 1 crore company, 50-50 share. So let's say and the number of shares typically in India, the share value is, $10 a share. So you do, let's say in this case, 100,000 shares so that you get to this 1 crore number. Yeah, so simple. The division number of shares each one's hold, each of the two co-founders hold, you know what the total value of the company. Now let's say you're raising money for, let's say 25 lakhs you want. Why do you want that 25 lakhs? For what is again a big question. You need to raise only as much as you require to be able to get your immediate objectives resolved. We haven't gone into that with too much of detail in this session, but I think there is science behind how much money to raise as well. So let's assume for this case, for this example, let's assume you're going with 25 lakhs. So you immediately figure out that, there is pre-money before the 25 lakhs came in, this was worth 1 crore. Now, after the 25 lakhs coming in, your total company value is 1.25. So the share that you need to give it to the investor is their 25 lakhs divided by the total value of the company, which is 1 crore 25 lakhs. That is their share of the company. And to that extent of the share, both your co-founders will be diluted. So let's say if 1.25 crores divided, so 25 lakhs, 0.25 divided by 1.25, let's say it is, for argument's sake, let's assume it is 5%. So that 5% is the stake of the institutional investor. It's actually 25%. So let's assume it is 5%. So to that extent, the investor comes in with 5% stake. And in your original 50-50, you would each go down by 5%. Yeah. So that's how it works. Again, math, I think we should leave it for later. But just the concept is when you get somebody coming in with some money, you need to be able to give up your share of the company to them because that's what they see as value that you're creating for them in the hope that your company will grow. Yeah. But there are signs around when you should raise it, how much you should raise it, and whom you should raise it from. Yeah. So these are three important things as well. We can't, because this is a 1 hour session, you can't go into too much of detail around all of those things. What is the next question, please?
The next question is, how is your experience about the current situation, the pandemic situation, and how is it affecting the market?
So it is certainly the case that, the pandemic has impacted revenue lines because there is so much of uncertainty around the future. Just think about how the pandemic itself, at one point in time, I think early Feb, we were talking about the fact that, it won't be prevalent in India because we have tropical weather, our cuisine is different, and all sorts of theories we had. But it did come to our shores, and it is now raging. And that has created uncertainty around jobs, about, net worth of individuals. And therefore, it is no surprise that the demand has gone down. On the other side, if you think about where each one is in their own, if there is no revenue line, how do you pay your salaries for people engaged with you? How do you ensure you keep the wheels of your business moving, paying your suppliers, etc.? So, there is potentially at this point in time a lot of demand for, capital and liquidity. So if as a startup, you are also, competing for some attention for liquidity and capital in this space, again, it depends upon whether you've got those basics right. What are the basics? Are you solving a real need for a customer? Or is it just flashy technology? Are you seeing, validation of your product in the marketplace? Do you have all the capabilities and resources required to unlock value? I think it goes back to the basics here. So yes, the situation is tight right now, but for people who've got good traction, whose business model is well sorted out, I think purse strings are still continuing to be open. In fact, there are many examples of people who have raised money even in this circumstances.
So there is one more interesting question. Do you think PM's Make in India concept would boost venture capital scope in India in terms of FDI coming in?
I think as it is, there has been a lot of shall I say risk capital. I mean, this question is specific about foreign risk capital, but I'm saying we don't need to necessarily depend upon foreign risk capital. There is abundant liquidity in the Indian system, and if you think about what's happening, bulk of what was going earlier to the public markets, which is your stock markets, whether it is BSE, NSE, or whatever stock exchange that you want to think about. I think from there, slowly it is moving into private markets, which is where we are, venture capital, private equity, etc. And that is because obviously the returns are much higher in the private markets than in the public markets. And you think about this, Amazon, Facebook, before they even got listed, how many rounds did they go? You would find that much of the value was unlocked earlier before they even went public. So one of the secular trend that we are seeing is that lots of activity is happening in the private markets. So to that question that somebody was asking about, this Make in India, vocal for local, is it incentivizing foreign risk capital to come? My sense is, of course, it makes it even more interesting. But I don't think even before that, there was a dearth that startups were really dying because there weren't too much of capital and liquidity around. I don't think that was the case. I think sometimes what happens is I think people get too much caught in by this fad. Everybody wants to create a company. Everybody is fascinated by the unicorn stories of Byju's and Paytms and all of that. That I think the basic piece about why are we in existence, what problem are we solving, I think is completely missed. So again, if there is one takeaway from this conversation, is just that. I think talent will always make capital dance, as in, if you have an innovative way of solving a client need, then I guess capital will find its way. I've believed that, and I think it is very true. So yeah, nothing to counter the theory that all of these schemes will only enthuse more people to try and understand the Indian startup landscape and to try and get some exposure to the Indian entrepreneurial ventures and risk.
That was a fantastic note to end the talk, sir. So if you are free to take up one more question, shall we
Sure.
go for one more? Yeah. So connecting to the last question, there has been an upsurge in startups in India. Do you think it will attract offshore venture capitalists too?
Yeah, I think it is the same as the last question, ma'am. Yes, I think there
Yes, I think, yeah.
The various corridors. I think people are trying to see whether one of the things that we do quite well is tropicalization. What do I mean by that? There is some great idea that has worked, seen traction in the Western markets. Can we try and see whether that same idea has currency in an Indian environment? Yeah, so the best way to do that is the same entrepreneur or the same institutional investor trying to find out ways and means to try and engage with the local entrepreneurs for a similar idea. So, transfusion of ideas, transfusion of capital, I think is very much the name of the game. Likewise, I think great ideas in India whether that has got applicability in other markets. It could be markets sharing similar characteristics like us. It could be Brazil, it could be Philippines, it could be Thailand. Yeah, some ideas that work here that could possibly be there, applicability there. So, these corridor plays opening up, for example, in the banking side, opening up a cross-border remittances, cross-border money flows, etc., I think is pretty much the name of the game. And this is typically enthused a lot of foreign VC players, foreign venture capital players, to be exposed to what's available in India and to engage with some of the local entrepreneurs. So you have many of these innovation labs, right? IIT has them, banks like us have them. So that is just the idea. So on one side, we've got entrepreneurs, the other side, we've got industry problems. So we try and connect these two. And in the hope, we try and learn what's happening in each of the industry, and in areas where it matters for us, we try and capitalize on that technology, capitalize on that business venture, etc. So it's a business idea for us, connecting these dots. Yeah, so in summary, let me just conclude by saying the following thing, which is, much as everybody is enamored by fundraising, I think it is important for entrepreneurs to be focused on the basics. The basics is, what is the value proposition for the customer? How is my product, service, technology different or better and can be more effective, efficient than anybody else? How is it that once I'm ready to launch, engage with the customer, what prevents from somebody else copycatting and eroding whatever gains that I have? These are basics. We have to solve for that. After this, we can get to funding. In funding, bootstrapping is possibly the best way to go. But depending upon the ambition, the aspiration, the scale, and some traction that you are seeing with what we spoke on the first section about value proposition, you could get to institutional investors to make a case for your business. That has two issues. First issue is, because you're a young, early stage company, the only way for the investor to gain a return out of your venture is if you continue to raise more and more money and ultimately list your company or provide an exit to the investor. That means that this is not, okay, I'm doing this just for the heck of it. Yeah, it has to be a careful, thought through strategy. The second one is, as the question somebody was asking, it involves dilution. That is, your share of the company will need to be given to the investor in such a way that it motivates them to be able to invest in your company. So if you go through 3-4 rounds, pretty much from whatever 50% or 100%, you would be down to 5 rounds. 50% when you start with, you will end up with 16, 15%. So overnight, you will find out that you don't own much of the company that you started with. It's not a bad thing necessarily, but I'm just saying one needs to be cautious about it. So with that, thank you for the opportunity. I will leave it to you, Nithya ma'am, to close.
Thank you very much, sir. I would welcome Suparna Deepak madam to propose a vote of thanks.
Very good evening to all of you. So as all good things come to end in life, so is this webinar. So on behalf of Institutions Innovation Council, I take this opportunity to propose the vote of thanks to those who have been directly or indirectly contributed to this webinar on Solve Jeopardy on venture capital. So at the outset, I thank our resource person, Mr. Ram Gopal sir. We are really enlightened with your knowledge, and I'm sure that the students have got the answers to many of their queries. We are thankful to our patrons, Dr. K.M. Vasudevan Pillai sir, the chairman of Mahatma Education Society, Dr. Daphne Pillai ma'am, the co-founder of Pillai Group of Institutions, for their motivation. I would like to thank our principal, Dr. Gajanan Vadir, and vice principal, Mrs. Deepika Sharma ma'am, for their enthusiastic support. A special thanks to the organizing committee, Mrs. Nitya Verghese, the president of IIC, and Mrs. Jenny Prajit, the vice president of IIC. A special thanks to our student representatives for their unflinching support and coordination. But last but not the least, to the lovely audience. And with these words, I will move to the end of today's program. Thank you so much for joining us.
Thank you, everybody.
Thank you.
Thank you, everyone.
Thank you, everyone. Thank you.